And when I stumbled into this chart, I was immediately, thinking, my brain just couldn't stop thinking about what do I do to participate in this? Because I believe strongly that the gold cycle will start and it will be one of the most important historical breakouts we're going to see in the history of the metal. And if that happens, the high beta version of the gold is silver. And I think silver is going to break out and it won't just retest the prior highs. It's going to likely go much higher than that. And so, how do I find leverage without using debt, but really looking for smart ways to allocate capital of myself, my clients, and family to then to really express that view in the markets, where if silver does break out, I really capitalize on this.
Hi, and welcome to this video. I've got Tavi Costa from Crescat Capital with me once again. Tavi, how are you doing?
I'm great, Mike. How are you?
Excellent, excellent. So you came out with another investor letter recently, your update to investors. And I just wanted to take people through this a little. So I want to share my screen here. And what we've got here is buy low, sell high. As your first chart here is repeated. So let's just go through this a little bit. And the first thing that you show is the incredible, a lot of this was covered in my recent book, the overvaluation of the stock markets, real estate, just everything. People were calling it, I was one of the first to call it the everything bubble years ago. But then I realized a couple of years out into it that it's not the everything bubble, it's the almost everything bubble.
Yeah.
And the real trick is finding the one or two things that there are in all of society and all of the economy that is undervalued, because there's just not that much these days. So do you want to take us through this and just pick out the charts that you want to describe and sort of share what your thoughts are about the most important things about, because I view the entire stock market, the entire economy, as very warped and twisted by the world's central banks and by the way banking and the financial sector works in general. And every once in a while, the forces of the free market come along and cause a correction, a leveling of all of the different sectors that get warped out of, and when it does that snapback, it's very painful for people that are on the wrong side of things.
So. Yeah. Look, I use the term buy low, sell high because it's such a simple term, but so complex for investors to actually apply that in real life, because there's always a new narrative and something that claims to be the new normal, and it's never the new normal. It's just cyclical in its nature. And this chart is just telling you that there are great opportunities to be buying in the stock market, and there's some things you should maybe avoid because of the risk. And so the chart is looking at market cap to GDP. It's Warren Buffett's favorite way of measuring valuation in equity markets. And you can see here on the going to the right side, you're seeing the most undervalued. So you have Argentina, Mexico, Russia, some other emerging markets or South American economies, and some other developed economies too. You have some European countries. To me, the one theme that you can find very easily in the bottom there is certainly the South America countries, the ones that are resource-rich economies that you can see, Argentina being the striking one, but certainly across the entire region, right? And then on the other side of it, you have the expensive economies, the ones that you should are completely unnecessary in terms of risk. And the fact that you have the U.S. at 180% of market cap to GDP, that is, an enormous amount in terms of overvaluing. This is not the only term. I mean, if you look at other multiples of the equity market that you have covered, the CAPE ratio being one, the cyclically adjusted PE ratio, you can look at medium terms of many fundamental metrics. Majority of them show you that U.S. is historically overvalued. And so to me, a lot of things are linked. It's hard assets are cheap, gold is cheap, silver is cheap. Economies that have higher exposure to those hard assets are also very cheap. Value stocks are cheap relative to growth. And so this chart is just one way to illustrate that whole thesis. Maybe we can go to the next one unless you have another point you want to make.
Well, in my book, I cover this, but when you take the average number of work hours that it takes to equal the points on the S&P, there's an equilibrium, and we're about 10 times higher than that equilibrium right now. It had never exceeded 40 in the past. It was always somewhere between 10 and 40 hours with an equilibrium, an average of about 22, I think it was. And we're up, everything is totally insane. For this entire century, the highest value at previous peak, when it came to the Buffett indicator here, market cap to GDP, was the year 2000 with the tech bubble. And we are way beyond that right now. And the U.S. average, going back to the beginning of the Buffett indicator data, is about 60% of GDP, if you're not including the bubble century. And but if you go globally, it's about 30% of GDP is normal. And so I just see that we've all gone insane, and someday this will come back to haunt us.
Yeah. So and then I go on to talk about AI, paradox, and other things. This is another chart that shows the relative performance of Latin American stocks. Again, is kind of emphasizing the region of Latin America relative to the S&P 500 specifically. You can see a double bottom for those who don't know. That's a technical term that when you retest the prior lows, usually it's a time that you want to be buying. So this is the case there. And then going further, I call this a new investment cycle. And the whole idea really is predicated on the history of the commodities chart, which is coming next.
Okay.
Keep going lower. There we go. And so you have basically from Incrementum AG, Roni shared this data with me. I've been looking at this data for some time now. It's basically looking at the commodity prices going back to the early 1900s. And what is fascinating about this, Mike, is the fact that we've had throughout history 3 real inflationary decades, meaning where inflation runs hotter than historical standards. Those were the 1910s, the 1940s, and the 1970s. Obviously, we lived through inflationary forces throughout the whole history, but those particularly decades had other issues that really reinforce those problems even further. But what is important here is that during those 3 decades that are the first ones where you have the arrows in this chart, you also had a commodity cycle. So 3 inflation decades, 3 commodity cycles. And then the fourth one, that is the fourth arrow there, is going back to the early 2000s, in which we didn't really see an inflationary era during that time. But what we saw was China having a manufacturing boom. They were building their economy, and that drove the commodities market in a large way, the demand side. And today, I would argue that we're seeing both things at once. We're seeing an inflation cycle at the very early stages of one. And the second thing is the G7 economies, not China only, but G7 economies really doing a manufacturing revamp to reduce reliability with other authoritarian regimes. And so countries or even businesses are going above and beyond to, instead of doing a cost-efficient approach, they're changing that to secure their logistics. And so that's creating a boom of commodities that we're yet to see in a much bigger way. And that ultimately, because this is the whole idea here, ultimately drives gold prices. Because I've never seen a gold cycle that wasn't driven in tandem with the commodity cycle too. So they're all involved in the same idea.
Yeah, I absolutely agree. This is an important chart right here. This isn't mentioned by a lot of analysts, and it's very important it's an inflation gauge as well, right?
Absolutely, yes. So this one's looking at World Container Index, and this is one index. There's another Shanghai index that in China that is showing the similar problem where the freight index or cost is going up. In this case, was going up about 60% in 1 week. And then some folks came up and argued with me and said, hey, but this is just a Red Sea. Yeah, I think one issue that a lot of analysts are having is seeing this inflation problem as isolated events. So you have, especially the geopolitical side with deglobalization intensifying over time, a lot of people are seeing this as, they're just independent things, and they are not. They're all linked. They're interconnected in a much bigger way, and it's the real reason why we believe we're entering an inflationary era. It's deglobalization at first. It's labor costs that is likely to rise. You've got the fiscal stimulus that is larger than other decades, and the chronic underinvestments in natural resources. So if you're looking to protect capital, especially from a purchasing power standpoint, I can't think of another thing but precious metals to do that for you. So to me, that's ultimately what this funnels into in terms of an investment thesis. And the
Yes.
fact that, yeah, and the fact that we might be entering a secondary inflation wave, because inflation develops through waves, as you know very well, Mike.
Yeah. So this next chart, the percent of yield curve inversions, and you have under there a graph of how many months that the yield curve has stayed above this 70% level. So tell us about all of this, because I see this as an extremely important graph.
Yeah, and it is. So a lot of people have done work in the yield curve inversion. In 2018, I've created this indicator. It's a percentage of yield curve inversions. Some people are gonna give me some bad time for this, but I actually presented to the IMF this idea, and the whole point was to calculate, looking at the entire yield curve instead of looking at independent spreads, then calculating how many of those spreads are actually inverted. And this is what the top line of this chart is doing. So 80% of spreads today are actually inverted. And the bottom line is looking at, okay, when you go
So
above this.
hang on. Before
Yeah.
we go in there, just give us a simple explanation of what a yield curve inversion is, and then how many different yields that you're measuring here
Yeah.
to get this 70%, because it's 70% of what? How many different
So
inversions, and what is an inversion, just so the audience really grasps how important this is.
yeah, so basically the calculation is taking all 45 possible mathematical spreads in the yield curve. So think of all the possible interest rates durations in the yield curve. So meaning you have the 12-month yield, the 1 month yield, the daily yield, the 5 year yield, the 7 year yield. So you take all those durations, so the maturities, and then you
Mhm.
combine them. So let's just say you're looking at the 2 year yield versus the 10 year yield. If the 2 year yield is above the 10 year yield, that means it's inverted. And so you do all these calculations across the yield curve, and how many of those 45 spreads are actually inverted. What we found throughout history is that when you go above the 70% threshold or recessionary level, is when you start seeing a contraction in economy unfold. And this is the importance of this chart, is that we've been already deeply inverted in the percentage of inversions for about 15 months now. We've been above that 70% handle for about 15 months. And as you can see here, this is by far the longest period we've seen in history. So what does that mean? We backtested this all the way to the 70s to look at how do you position yourself in situations like that. And what we found is yeah, you can short the market, or you can get long treasuries, you can be long gold. There are all sorts of things that can work in terms of asset classes when you reach that 70% threshold. But what really turns out to be the best investment in terms of a hitting rate or success rate that we call, really is buying gold and selling stocks, believe it or not. In other words, is the gold
Wow.
to S&P 500 ratio. So I think it's going to work again personally, and that's the most attractive investment position for using this chart.
Yeah, there's a couple things that I see here in that, there's some others during the 70s and 80s. You see yield curve inversions, but it dips below that 70% once in a while. This time it has just consistently stayed above.
Yeah.
Second is that the longer this is 15 months on this chart, and the longer it stays inverted. So for the listeners, um, the short-term end of the interest rates, so 1 month and such, this is the end of the interest rate curve that is more manipulated by the Federal Reserve.
Mhm.
And the natural state of things is that investors, the bond vigilantes, are trying to look into the future and see how much risk they think there is in loaning their currency for different periods of time to the government. And the longer that period of time is, like the 30-year, the 20-year, the 10-year, the more they want to charge, because the more uncertain things become in the future. It's harder to see 30 years in the future than it is 1 year in the future or 1 month into the future. And so the natural state of affairs is that the longer the duration is, the higher the interest rate is. And when you get these peaks where low durations, now this could happen from some sort of event, but normally it's because of central bank manipulation that causes the low end to go higher interest rate than the long duration bonds, notes, and bills. And so what I see here is 15 months of energy building up in the economy as the economy gets more and more warped from manipulation, not allowing the free market to work. And that means when it snaps back to equilibrium, it's going to be even worse for the general economy because of the artificial pumping that's going on. And it's going to be really bad for the people that are not positioned correctly, but it's going to be really good for the people that are, because there's much more of a wealth transfer that will happen. Do you agree with all that?
Absolutely. And I would say there is so many important takeaways from this chart. Everything you said, I agree with. And another macro idea that a lot of people come up with by looking at this chart is note how prior inversions, we also had a de-inversion, meaning the steepening of the yield curve. So it goes above 70%, and then after you have an abrupt move to the downside. And so there's a way in the markets you can bet against that, or meaning the steepening of the yield curve, or the 80% declining or plunging from those levels. And usually that occurs as you have the recession actually unfolding. So it's a really interesting way as well to position in the markets. We've been doing that in the 2-year versus 30-year. I'm not trying to be very complex in terms of the ideas, but that's one thing that in the macro community, as you watch this unfolding, it's an important one to for positioning for a recession as well. And it unfolds in stagflationary environments and even deflationary shocks. And this is the interesting part of it. So it's another one that we're looking at in terms of ideas to invest. Now, in terms of going to next charts, Mike, unless you want to go on here further.
Well, the only thing is that in the other events, there was these pullbacks below the 70% line. So some of that energy unwinds. Here they have been successful. And I want, normally, for the audience out there, normally the recession begins when the yields start to revert, not invert. When they start to go back to normal, that's when the recession begins. I'm sorry. The recession, so this soft landing stuff that everybody thinks is actually happening, the longer this stays this way, the worse the snapback is going to be. So that's my only comment on that.
Agree.
Just another skewing of the economy. Do you want to comment?
No.
Or do you want to? Okay.
Well, I think it's not as relevant for this. So if we go down
Right.
to keep going lower, there's a good one. There you go.
Okay.
This one's just looking at the capex for the S&P 500. It's basically showing you, again, this goes back to the idea of money not flowing into the necessities that we need to run and efficiently a global economy, meaning materials, commodities, and other boring businesses.
And to survive.
Yeah, and it shows how we've been throwing all this capital into technology and forgetting about the rest of the other sectors. And remember, back in the days, technology used to be a very a type of business that didn't require a lot of capital. Today is the opposite. I mean, this is the most capital intensive sector of the economy right now. So AI, while it is transformative and some great ideas coming up from that technology advancement, it's extremely expensive. I mean, look at this yellow line is basically showing you how will the cyclicality of this sector change as these businesses require more and more capital to grow less and less in terms of revenues because they're already the economy. They're too big already. So
Right.
this is an important chart in terms of the capital flows coming out of this sector and maybe coming into hard assets, businesses that are involved with hard assets, commodities, producers, and so forth. So this is why the importance of this.
Yeah.
If we keep going lower, I think there's an important chart, keep going lower, of commodities in a range. There we go. And to me, this is a setup. I mean, we've been in this 18-month range where the commodity prices have been kind of going sideways. The Fed is cheering on, saying that they won the war against inflation. Essentially, they pivoted. They changed their stance to from hawkish to now dovish. And when I look at that, and I look at the price of commodities, I don't think they've accomplished anything. I mean, the underlying issues of natural resources being so undersupply have not been fixed at all. I mean, we're in the business of investing in these companies, and access for capital remains very difficult. And so there is a reason why, despite the positioning that comes, can be quite cyclical in markets, you're still seeing this range where commodity prices have not left this range for 18 months. And if you ask me, we're probably going to go through this range and break out and then reaccelerate on inflation. And this chart pairs well with the next one because when you look at an analyst, if you go to the next chart, they're all expecting in record amounts that inflation is going to decelerate. That's what this chart's telling you. It's how many of those investors, Bank of America does this research where they ask their fund managers, how many of you think inflation is going to decelerate? And guess what? It's record levels today. They all think inflation is over. And what if it isn't? What if this deglobalization problem intensifies again and the container index goes up a lot more? We have a second wave there. Or what if commodity prices break out from that range that I've been referring to? There's so many what ifs when I have a consensus view in markets that is often wrong, saying that inflation is dead, and it's not true at all. It's very structural, and most likely will accelerate again very soon, in my opinion. And we're probably going to get into the second wave of inflation.
Yes, I do want to point out to everybody here that this is the peak of the 2007 real estate bubble, and this is like the global financial crisis. This is 08, 09 would be right there. So you're talking about, we're already way deeper than the bottom of the global financial crisis, than the bank's inflation expectations during that period of time when the entire world economy just about froze up, the entire financial economy just about stopped. I mean, these are crazy levels. Okay, this is like the gem of our whole conversation here, or one of them. This and I believe the next chart are the ones that are what everybody was waiting for. So we've shown this chart before, I think, in one of our conversations, but it's worth revisiting.
Yeah, it's the whole point of when you're thinking about buying an asset for the next 5 to 10 years. The biggest idea is to find something that is not crowded, in other words, uncrowded, and at the same time that has the very high potential for changing that dynamic in a large way, driving capital into that asset, and then driving the prices a lot higher. I think gold it fits into that whole thesis. And the main reason is because you have to look at two pools of capital. And here you're looking at one of them. That is the fund managers, the pension funds, and all these types of investment strategies that are completely under allocated towards gold. And as you can see here, 71% of those advisors own 0 to 1% allocation in gold. And I think the more even striking point about this chart is the very last portion there, where it shows that 0% of them own 10% or more. Yeah. So, I'm going to guess Mike owns more than 10%. So, I don't think they surveyed him or myself, but certainly this is astonishing. And when you look at central banks as the second pool of capital that is very critical to potentially come in and change the price of the asset, meaning gold, and you looked at historically what's been happening with gold purchases by central banks, yes, we're seeing record amounts today, which is really positive for gold investors. But throughout history, they only own less than 20% of their balance sheets in gold. Back in the 70s or
Yeah.
late 70s, early 80s, they own close to 80% of their balance sheet in gold. And so there is a potential for a change of allocation in the metal across those central banks internationally. And I believe it's going to happen. So those two pools of capital are yet to come in and change that in a large way. And it will create, in my view, a gold cycle. This is why I get so excited about buying gold related businesses, because I think that's ultimately where we're going to be making money and probably generational wealth opportunities in the next 5 to 10 years.
Yeah, well, I see it this generational wealth opportunity. I think we don't have to wait 10 years anymore. I mean, I've been waiting. I started gold investing in 2002 at $315 an ounce. And for me, I mean, I've watched it this whole time, and I've watched like these advisors that have no exposure to gold whatsoever, and I've outperformed the S&P like by a factor of 6. And if you measure from the beginning of this century, I said decade, I meant century. If you measure from the beginning of this century, it's the other than cryptocurrencies, it is the number one performing asset class is precious metals, and I just don't see why. And it's the safe haven, and it's got a floor under it. You know, it can't go to zero. It's not possible. It's a commodity. And so it has a certain amount of mining costs. And if it goes below the mining costs, supply starts to dry up eventually. So it has to eventually catch up with the mining costs. So it's always got this minimal downside risk, and the upside potential, I think, has a central bank guarantee on it. The guarantee is that the central banks will always print more currency because they have to. Mathematically, the way a debt-based monetary system works is if you don't continue inflating, you die. You go into an inflationary implosion. And so the gold miners to gold ratio, do you want to say anything about that? Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video. The gold miners to gold ratio, do you want to say anything about that?
Well, it's a distress opportunity, and thinking about valuations today and things that are cheap and buying low and selling high. This is certainly in the buy low category. And miners have just underperformed gold for so long. But when you enter a cycle, that doesn't happen. Usually what you see is gold miners actually tend to outperform the metal in a large way. If you ask me, I think we're setting the stage for that to happen. We're very close to a major breakout in the mining index relative to gold price. And if that happens, I think we're going to accelerate to the upside. And the interesting thing about precious metals overall is that we're seeing this across the board. It's not just miners versus gold. I mean, just look at the next chart, not necessarily this very next one, but I think there's a silver chart that comes in after. Maybe you want to set the stage for this chart here, Mike, but it's
your high beta version of gold. This is a great title for the high beta version of gold. So this is gold with greater volatility to it, basically, right?
Yeah, I mean, I'm younger than you, Mike, but when I stumble into this chart, I've immediately thought about how do I business, build a business around this, because I think smart people that make a lot of money in the markets are the ones that identify big macro trends and build vehicles to invest in those ideas. And there are so many ways you could do this. You can just start by buying silver, or you can just actually build a mining company, invest in mining companies. There's so many different ways to skin the cat. And when I stumbled into this chart, I was immediately thinking, my brain just couldn't stop thinking about what do I do to participate in this? Because I believe strongly that the gold cycle will start, and it will be one of the most important historical breakouts we're going to see in the history of the metal. And if that happens, the high beta version of gold is silver, and I think silver is going to break out, and it won't just retest the prior highs. It's going to likely go much higher than that. And so, how do I find leverage without using debt, but really looking for smart ways to allocate capital of myself, my clients, and family to then to really express that view in the markets, where if silver does break out, I really capitalize on this. And so, to me, this is absolutely critical for those that haven't seen this chart yet. It's just basically showing the quarterly candles of silver going back to the 80s and 70s, and you can see, the prior highs of the 70s and 80s, and the Hunter's Brothers, and then you have the later that you have in 2011, another high that we retested that created a double top, and we've had a large decline coming from that, and now we've been sort of consolidating in this below this resistance that goes back to 2011, which is what the line is suggesting. And if you ask me, we're going to break out and go much, much higher. And if that's the case, you have to ask the question, how do I expose myself to that breakout? And that's why I spend most of my time thinking, to be quite honest.
Yeah, I do have a couple of comments on this chart because first, for the audience, name another asset that is still below its 1980 highs and has not exceeded it. On the Chicago Mercantile Exchange in January of 1980, gold hit 52.50. The peak was 48 in 2011. So it still has not broken that 1980 high. And then I sort of allow the gold silver ratio to dictate what I'm going to buy. There are times when there's, like during COVID, both metals crashed and the silver went down so much, but there was so much fear that I wanted to buy gold. Everybody wanted to buy gold. And that's what you think of during a panic event, except the gold silver ratio went up to 120. I couldn't buy gold when silver was 120th of the price. And so I bought some large positions in silver down there at the bottom of that dip. And so of my precious metals holdings, the value of them is more than 90% silver. It's probably only 5% gold. And it's all because of allowing the gold silver. When we get to gold silver ratios under 50, then I only buy gold. I don't buy silver. But it's been over 50. I mean, there's only during that peak of $48 was the only time that it's been under 50 for any, for a few months. Back then, I would not allow myself to buy silver because silver was sort of overvalued. I bought only gold. And then when it went back down, I started buying lots of silver again. So it's all that's in my book. So do you want to say anything about the last chart? Treasuries more volatile than gold?
Well, yeah, because the last I was really trying to think about what are some of the most important charts of 2023 to me, and that I've worked on. And to me, this is it. This is the fact that we now have gold less volatile than treasuries. That's what this chart really means. It's looking at the downside volatility of one asset versus the other. And it's basically saying that in the last 45 years, gold has always been more volatile than treasuries. For the first time in 45 years, gold is now less volatile than treasuries. And so what does that mean? If you're holding a large portfolio where you worry about risk and you worry about the downside of equity markets and volatility, and you're trying to suppress that in your portfolio, gold may be an alternative. And as I showed in that chart, that 70% of them own 0% of gold. Those are the types of metrics that bring that capital back to the gold space. So
this chart is saying that, the ultimate safe haven investment that has no counterparty risk, that you can actually hold in your hand, bury in your backyard, lock in a safe, have it in insured storage somewhere, is actually, it's the ultimate safe haven that people run back to. And right now, it's absolutely proving it. It is being so much more stable and that's measured against a fiat currency. You're measuring this against the percent change in dollars of bonds versus gold, right? That's what you're measuring.
That's right.
You're
Yeah.
measuring a dollar amount change, and this is more stable than U.S. Treasuries currently. So, anything you want to say here at the end and wrap this up?
To wrap this up, I mean, often people say that silver prices have underperformed for so many decades, and we still have not retested the Hunt brothers peak. And to me, that's just a reason to be interested in the asset. And the whole reason is the fact that it hasn't yet outperformed other things, and it's so off the radar. And
Yeah.
if gold is off the radar, then silver is that in steroids. And so to me, it's why I think it's such a critical asset to own the next years, and why it's so relevant to my thesis and yours as well.
Yeah, you mentioned the Hunt brothers peak. I interviewed Jeff Christian of CPM Group years and years ago. It was like 2005, and I never put out the video, but in there I asked him about the Hunt brothers peak because I had a theory that the Hunt brothers were sort of used as scapegoats to actually cap the price of gold, uh, and because silver is such a small market compared to gold, and both of them were taking off, and the Hunt brothers were the only single entity that was hugely vulnerable to a manipulation. And he said to me that the Hunt brothers added 50 to 75 cents at most to the price. It was really the public changing their preference from gold to silver as gold became perceived to be too expensive. It had been $35 an ounce at the end of the Bretton Woods system in 71, August of 71. And by November of 1979, it had passed the 400 mark. And so it had already gone up more than tenfold. And, the average income in 1979 was about $9,000 a year. It wasn't, it's less than $10,000 a year. And so a guy that was in his 40s or something, might go into the bank and withdraw $500, which may have been a large percentage of his life savings, rush into a coin shop and say, I want to buy gold too. And they drop one coin in his hand. He goes, oh, is that all I can get? And how much is the silver? Well, you can get X amount of those for each. And so it's the public changing their preference that caused it. And because the Hunt brothers got charmed by margin in the first half of their buying, there was no margin. They weren't playing future. They were buying futures, but they were taking delivery and flying the bars to Switzerland. And then the second half of their buying, though, they went out on the leverage of just playing futures, and they had such a large position that they became vulnerable. And the Commodities Exchange did position limits. They kept on changing. They changed the rules on them 3 different times. And it was when they finally implemented a rule that says that until this rule is lifted, the price of silver can only go down. When you're doing liquidation orders only, meaning that you can only close out old futures contracts, you can't really open a new one. Liquidation orders only basically is a rule, like a law. Price of silver can only go down. And most of the floor traders and the brokerage houses, they're trading both. And there's a lot of investors that were trading both. And so what do you think the guys in the gold pit on the commodities floor are saying to themselves when silver has just been capped? They're saying, oh my God, if they can do that to silver, they can do it. We're next. And so there's a reason that gold and silver peaked on the same day. And I really, after going through a stack of books like this, this was about back in 2010 or 11, I wrote an article about the Hunt brothers were used to cap the price of gold. And there was a reason. Paul Volcker, the chairman of the Federal Reserve, was involved in some of these decisions. The Commodities and Futures Trading Commission, in all of these things. So I find it fascinating, but I can't find another asset that is as undervalued as silver. That's the important takeaway from all this. What's your opinion?
Oh, I'm with you. I can't. I dream about that chart every day. I would marry that chart. Don't tell my wife.
Okay, this chart right here. This chart right here. Yes, this is one of the most bullish charts I've ever seen. So I want to thank everybody for watching. Please like and subscribe. And Tavi, where can people find you?
At Tavi Costa at Twitter, on Twitter, and also at crescat.net in our website. You can also find our stuff. But thank you very much, Mike, and Happy New Year to you.
Thank you, and we'll see you next time.